Today's topic is depreciation.
What is depreciation?
Depreciation is an accounting method that spreads the cost of an asset over its expected useful life to give you a more accurate view of its value and your business's profitability. As opposed to recording the entire cost of an asset as soon as it's bought, businesses record depreciation as a periodic expense on the income statement. How much value an asset loses year over year depends on which depreciation method your business uses.
What are the types of depreciation?
The most common four methods used for calculating depreciation are 1. Straight line depreciation. 2. Salvage value, residual value. 3. Units of production depreciation. 4. Sum of years digits depreciation. Note: depreciation accounts for decreases in an asset's value over time. The best depreciation method for a company to use depends on its accounting needs, types of assets, size and industry. A brief explanation of these four types. 1. Straight line depreciation. The straight line method calculates an average decline in value over a period. This is the most common method and the simplest way to calculate depreciation. In straight line depreciation, the expense amount is the same every year over the useful life of the asset. You can use the straight line method on assets such as vehicles, office furniture, equipment, and buildings. Formula: straight line depreciation equals cost minus salvage value of the asset, divide by useful life. 2. Declining balance depreciation. The declining balance method assumes an asset is valuable in its earlier years and loses value in the coming years. It declines over time until it reaches its salvage value or full depreciation. New companies or those expecting less revenue in their first years may choose this method to lower tax bills by claiming larger depreciation expenses. This method is also known as the diminishing balance method, reducing balance method, or written down value method. Formula: declining balance depreciation equals beginning book value multiplied by rate of depreciation. 3. Units of production depreciation. The units of production depreciation method calculates an equal expense rate to each unit produced. This type of depreciation method is most useful when an asset's value lies in the number of units it produces or in how much it's used, rather than in its lifespan. The higher the production, the more the expenses. The units of production depreciation method accounts for those conditions. Formula: units of production depreciation equals original value minus salvage value, divided by estimated units produced over asset's lifetime, multiplied by actual units made per accounting period. 4. Sum of years digits depreciation. The sum of years determines depreciation at a rate faster than the straight line method but less than the declining balance method. It yields higher depreciation expenses in the early years and declines later. It's useful when an asset loses most of its value toward the beginning of its useful life. Formula: SID depreciation equals remaining lifespan divided by SID, multiplied by cost minus salvage value.